Type 9. Type 9. Type 9.
Good morning, traders. Welcome back to another live stream on a Wednesday with the Fundamental Wednesday with the Everyday Growth Advisors. I hope you guys are having a great day. Welcome back to the stream. Have a pretty jam-packed schedule today once again. I try to keep these streams as packed as possible with information so that it provides you a really accurate update with the market. Hope that you guys find these things useful. And today I'm going to be dropping a lot of information with regards to how I see the market doing in the short term, and also what sectors to rotate out of, or what I'm looking at to rotate out of after this. So definitely keep your ears open today. Today's a great day to attend the stream, and one of those days where we're setting up a new play after we have already successfully got ahead of one play. So today is a day where we're going to set up ideas to succeed in the near future. Okay. Really quick over here, let's go have a look at the pre-market movers and see what's going on. Also, let's have a look at some of the news that we always do and see what's going on there as well. Haven't pulled those up, but it's all good. China to bring up WeChat, TikTok, and next U.S. trade talks. Okay, that still continues the saga with that. More job losses in Southeast Asia. Tencent's profit surges as growth hits fastest pace since 2018. See, it's funny because I mentioned this, maybe one or two live streams before. I said Tencent is a really great company to own long term. They rule the Chinese market in a lot of different sectors: gaming, communication, just IT in general. They do a really good job. So I I think that it's a good long-term investment. 10 cent. I honestly would buy it on a dip, but I'm still waiting for it to come down a little bit more so I can get in. So U.S. futures rise with bond yields, gold rebounds. Okay, the saga with the U.S. dollar continues here, but remember, it can't last forever. Okay, the U.S. dollar will not forever be this low. At this moment, yes, it is, and that's partly also the reason why the stock market's rallying. With a cheaper dollar, you can buy more things. Stocks are cheaper, everything else is cheaper, and you can also most assets are dollar denominated, so everything becomes generally cheaper. Okay. So this temporary moment is something that majority of traders are interested in, a time where they want to take advantage and invest. Okay, so keep that in mind. Okay, S&P futures rising, pointing to August rally extension. And then, let's see, Airbnb planning to file for IPO in August. Federal Reserve COVID response fuels private equity debt boom. And then Tesla announcing a 5-to-1 stock split. Expect this to definitely cause the stock price to pop. It already popped after hours, but definitely going to cause it to go up a little more. Should you buy into the rally? That's up to you, and that's subjective. Personally, I prefer not to. Okay. I prefer not to chase rallies. If you know my trading style by now, you know that I like to look for value instead of chasing the hype. So I look for value, and that's what I look for. I'm a value investor. And if you want to really narrow it down to what my style is, I'm a value momentum investor, right? I look for momentum as well. Okay, so if you're here in the stream, welcome in. Good morning. Smash the like button if you can. Let's try to get to 100 likes today if we can. I would really like that. It would really help to push this video to other people. So I really hope that we could really just take a second to smash the like button. Okay, so let's get on with the market updates here. Okay, so you can know that the overall market news, or the news being covered today, is leaning bullish. Which is, representing less anxiety, less worry in the markets. And that usually means that traders are going to be more likely to buy into rallies. Okay. So moments like this is where you have to be extremely cautious and take a step back and reassess if things are overvalued or undervalued. Okay. And we're going to get to that in a second here. So let's have a look at a few key movers here. Pre-market, Jeff here. I'm not sure what that is. That's another one. MGIC, Moderna up 8% on some virus news. Grubhub up 7%. Tesla up 6% on the stock split news. Let's see here. What else? And then what got sold off? Anything interesting here? Dick's Sporting Goods, Windham. Okay, not really that many things. Let me get my charger here. I feel like my computer's gonna die anytime soon. Oh, there we go. Okay, perfect. And then on investing.com we have, I follow two different ones because they track things a little differently. That's the reason. And then I like this calendar down here. We had some positive news come out for CPI, which is Consumer Price Index. So that's tracking your year-over-year inflation. Inflation is at about 1.6%, better than expected. Well, this is the core CPI, so this is going to be excluding energy, excluding food and energy. Okay, so we talk about inflation here without food and energy, which make up for a different kind of CPI. Okay, real earnings month over month, and then we have CPI month over month is 0.6, and CPI index also doing a little better there as a result. So in terms of news, we're looking okay. And then let's see here. Okay, Moderna, iGate Pharmaceuticals, Neo up another 2% here. Dow Jones, we have GE, we have let's see here, Tesla, right? Okay, usual suspects, nothing new here. Okay, cool. Well, let's do the SPY technical update here. and have a look here. So let me just quickly see what's going on in the chat. Good morning, guys. How are you doing? Welcome in. Welcome in. Smash that like button if you're here. Subscribe if you haven't. This is a stream which is a purely educational stream. We concentrate on giving, or rather teaching you how to fish rather than giving you the fish. We're not one of those YouTube channels that call out trades all the time. And my main focus here is to make sure that you know what you're doing going into the trading day. So I break down the market for you and I help you out with that. You just got to sit back, relax, enjoy your coffee, and just attend. That's all you got to do, attend. And if you attend, I'm almost a 90%, like 90% sure that it will pay off, because I know you have attended this stream for a while and you have made money. Throw a couple of fire emojis in the chat. I would really love to see how many people who attend the stream have been making some money, okay? Like from the stream, okay? I would really like to see how many people are, you know, seeing positive effects from being in this stream. That really would warm my heart, okay? Throw a couple of fire emojis. Tell me how you feel, okay? Is it worth getting tech calls? Okay, we'll talk about this in a second. Okay, cool. Okay, now we're gonna do a technical update here first. Tell you what I'm looking at. Go through the different scenarios here. We're gonna do the SPY, Dow Jones, and NASDAQ update here. We cover all three now, so I'll start with SPY here. As I said yesterday, if you attended the webinar yesterday, within the first, I don't know how many minutes it was, but if you attended the webinar yesterday, we had a special webinar, okay? And during that webinar, within the first few minutes, I said that be careful that we're gonna have a little bit of a retracement, right? And you know, to basically be cautious about what you're seeing, okay? I think it was around the 8-minute mark.
Temporary pullback for us to kind of gain more liquidity down here to push up and break through this resistance up here. So keep that in mind. And also,
so it was somewhere around here, and around the 8-minute, 20-second, 8-minute,
kind of creeping up to all-time highs here. We have to be very cautious at this level because it could easily be rejected here and come down with a double top.
And fast forwarding, rejected and came down. Right on point there with our analysis. Obviously, we know this is a key level here, so not really a very surprising thing to kind of predict here. This would be a key level for bears to take over the market. So remember, we need to see some kind of a retracement back down, either to this fib level or down to the moving average here, which is going to extend up. Now, alternatively, SPY could continue trading sideways, but that's unlikely. As we see a nice little rejection here, we should see some bearishness in the market. So as I have been talking about for the past, I don't know, 4 or 5 days now, you should be looking at taking hedges right now, okay? You should be hedging. And how are you supposed to hedge? You should be buying into UVXY calls, right? You can even do VXX calls. This is a ETN. You could do SPY puts, but these are likely to be, well, it depends on which ones you get, but you could get, sorry, that's not calls there. It's supposed to be puts. So definitely looking at some SPY puts here, right? Possible. There are many ways that you can do this, okay? Now, alternatively, what I like, I'm talking about just for SPX here, okay? How do you hedge against SPX? Those are the 3 obvious ways, right? Now, the other way you can do it is to buy an inverse ETF, okay? And then see how that performs as well. Now, you have to look at the risk to reward ratio, so make sure that you calculate that and make sure that your contracts that you're taking have low IV, okay? So take contracts with good Greeks, and if you want to buy them, I recommend to buy them for a month out, okay? At least 30 days expiry, so that your contract has time value, okay? And you give yourself more time for your idea to play out, okay? So stop taking weekly contracts here. Now, I know this goes against what I usually do, which is take weeklies for hedges, but at this given moment, when you're at an all-time high situation like this, your strategy should change a little bit, okay? Playing the weekly contract here may not be in your favor. Why? Because many traders are going to be thinking the same thing, okay? And they'll all be inclined to jump into weeklies. So what you have to do is switch your strategy. Remember that you are not playing the market here. You are playing other players, okay? whenever you're options trading, remember that you are trying to gain money from another idiot sandwich that's out there. And when that idiot sandwich buys your contract or sells your, or you sell a contract to another idiot sandwich, then you make money, right? So this is all a game of who screws who. And if you want to be screwed, then don't do your due diligence. But if you don't want to be screwed, then be smart and try to look for alternative strategies to outmaneuver the market. Okay, so that's my little 2 cents with SPY here. I think that it's an ideal time to hedge, and I think that it's a good time to buy some longer term hedge positions. Okay, I'm not saying go all out. What I'm saying is put a very small hedge, like 3% of your portfolio. Okay, 3% of your open positions, and then gradually move it up to 5%. All right, that's what you really want to do here. Okay, cool. And then now with the NASDAQ here, you can see what's going on. And the reason why I'm talking about hedging on SPY here is because look at how the NASDAQ is looking over here. It looks extremely weak. It looks like it will make a move down here. Now, if the NASDAQ does indeed do that, what is 20% of SPY? It's actually technology and innovative and disruptive companies. So when the NASDAQ goes down, it's going to take SPY with it. This is the reason why I say that the rejection on SPY is only going to get a little more clearer today than it was yesterday. Now this reversal candle here, the green one that you see on today, looking at it on the 1 hour chart here, oops, a bit too squashed up here, so there we go. Okay, so you can see here we had a little bit of a dip, and then what we're seeing here is a continuation thing, and then move up here. Now this could be two things, right? It could be either the start of a downtrend, right, where this is the impulsive wave and this is the corrective wave, or this could just be a dip on the uptrend, right? So why I say to take hedges here is so that you would be protected if something makes an abrupt downward trend. Now, SPY can technically go all the way down to this trend line here, okay? Even if it breaks the 200 moving average on the 1 hour chart, that's going to be a nominal correction, considering that we have had a monster rally for the past consecutive 8 days. Okay, so remember that. Now on the NASDAQ, it makes more sense here that tech has to correct out. Now, tech has been on an insane rally as well. Doesn't mean that we can't go higher. Yes, we can, but we need a little bit of a break, a little bit of a cool off. I say tech comes down at least to the moving average and this channel that I've drawn, right? We should meet somewhere around here. So a little room more down to go, which means that we have a little bit of bearish pressure today. Now this is looking on a daily chart. So let me show you what that looks like on the hourly chart, right? Okay, there we go. So we have about a downward move here, which makes sense. You can see that where my trend line is, it should come down here to touch this trend line before moving back up again. Okay, that's what I see, along with the Fibonacci levels, of course. Okay, so remember that, when we're trading, we're looking at multiple things. I don't just look at the technicals, I look at the fundamentals as well. And then I kind of marry those both ideas together to come up with the trade idea. Okay. Now the Dow is in a completely different place here. The Dow is barely breaking out here, okay? But what's going to happen is when these two go down, the Dow is going to be high. And I kind of find this weird because, as I said yesterday in the webinar, I see a lot of YouTubers now saying, guys, it's a time to get into industrials. Guys, it's a time to get into McDonald's and this and that. To that, my reply to you is, if you believe them then and you trust them, then go ahead. But to me, I'm going to say that the time to get into industrials was before we did anything like that. Okay. Ooh, thank you, Taylor, for the $149 donation. I appreciate you, man. Ooh, so many fire emojis. That is amazing. I'm so glad to see that. Okay, now with a little other thing that you want to take note here. Okay, and I do this purely for educational reasons, so I want to show you a little something. Okay, and this is going to go, I'm going to try and cover this with as much info as I can right before we get into the XOM mobile fundamental analysis, which is part of the fundamental Wednesday, right? Look at the S&P 500 PE ratio. Now, for many who don't know what the PE ratio, what this is the price over earnings, okay, of the S&P 500. Okay, and why is this a good measurement of the entire market? It gives you the price in terms of dollars versus the earnings and tells you how expensive it is. Okay, if price is more than earnings, then the value is more than 1, right? If price is less than earnings, the value is less than 1. Now, never, obviously, we don't ever have less than 1 values for PE. Majority of the time, they are positive values, right? And in fact, for the history of the stock market since 1880 till now, we've never had a single negative value, right? Because the stock market always gives you positive returns, right? So looking at how expensive the PE ratio actually tracks how expensive the stock market is getting, okay? And if you can see down here, right, we actually know that the S&P 500 PE ratio, the mean is about 15 to 16, the median is about 15 as well, and then the maximum was post-financial crisis. Now, can you see what is happening over here? Now, this is right when we had the 2008 financial crisis. In 2009, this is what happened. Our PE ratios were completely crazy because of inflation, a bunch of other things, the way asset pricing was completely in a bubble, right? And that year preceding to 2009 was a very crazy year, right? Well, you can see that now S&P 500 is kind of getting into the upper bound of the PE ratio, okay? So are we super overvalued yet? We're not super overvalued, but you can see we are starting to creep up here now. We're starting. Now, when it approaches 30 something and 40 something, this is the time when you have to be cautious, okay? Cautious. And you have to put your money into defensive investments. Okay? And we will discuss this at a later time when that moment happens. Right now, we have still some room to go. Okay? We still have some room to go. I say we can still push up all the way to here or here, right? Without having much of a problem. Okay? Because the market still needs to push through the all-time highs with the Dow Jones. The market still needs to push through all-time high with SPY. And the NASDAQ is already at all-time high, but it still can rally, okay? So when all of that happens, it's going to push the PE ratios even higher, which signifies that stocks are getting more and more expensive with respect to earnings, okay? So this is something, food for thought on your Fundamental Wednesday, okay? Food for thought. You know me. I don't like to tell you, I like to teach you. Okay, so this is your food for thought today. Remember that we are approaching alarming levels. Okay, approaching. I didn't say we are there. We are approaching. Okay, so you kind of have to look both ways before you walk across the street now. Okay, so keep that in mind. Okay, now the next thing is, and let me just read the chat here. Let me read the chat here real quick. Remember, all these things that I'm teaching you right now, if they help you out, remember to smash the like button, because honestly, if you don't smash the like button, what's going to happen is nobody else finds out about this stuff, okay? So if you want to do your community or, you want to do society a favor and share this video with somebody else, I highly recommend to smash the like button so that YouTube doesn't recommend your video unless it has a bunch of likes on it. So, the amount of fire emojis. Thank you, man. This is my second stream of yours, so hoping to post fire emojis eventually. Absolutely, Aubrey. Well, welcome back to the stream. I appreciate you being here. Thank you for taking the time to be here. I have been that idiot sandwich. We all have, Dahlia. We all have. Tea spitting knowledge. Don't ask what. That's God hate me later. Great. We got to show love. Thank you, Taylor. Thank you. I appreciate you, man. Even $1.40, that goes towards buying my coffee. So thank you. Okay. Next thing here. So this goes in and starts to play into what I'm looking at. And so how do we play this market going forward? Okay. Now, am I saying that you should be rotating out of industrials right now and straight dumping your money into this? No. What I said at the beginning of the stream is this is my next move. Okay. What I think about it, how I think about it. I want to show you my methodology. I want to give you the logic behind it, because then if you follow the logic, then you see my understanding why I say these things and why, I come up with these ideas. Okay. Now, pulling up, and by the way, I show you how I do it. So literally, you can be doing this on your own. Okay. The market is not about what tools you use. It's about what you use and how you use them. Okay. So it's about finding the right information, but also knowing which questions to ask. Okay, it's about knowing which questions to ask, because if you don't know the right questions to ask, how are you going to get the right answers, right? So you have to ask the right questions first of all. Okay, so the question is, how do we know what's the next play after industrials and after the the sector rotation into industrials, consumer staples, right? Well, to get that answer, what I would simply do is find out what are the best performing sectors and what are the worst performing sectors, right? Now, I know many of you are going to say, oh, is this a good time to buy tech? Guys, the tech rally, for the best time for you to buy tech was here. Oops. It was here, right? Here, breaking out. That was still a good time. Now, when we're at the top here, you're asking me, should I buy tech? You can because tech will probably go higher, but is there a good risk to reward? Ask yourself this question. For every dollar of risk that you take to buy tech up here, what is the reward that you're going to get? Ask yourself that question. If your answer is your reward is going to be high, then take the trade, right? If you think that the reward's going to be low and you get less than $1 for every dollar that you put in, then don't take the trade, right? So for me personally, I don't see the risk to reward here, right? I see more risk. I see more reward on the downside than I do on the upside. Why? Because tech has already rallied, right? But what sector is dead? What sector is the most risk to reward sector in the market right now? You have to look at that. Okay, so looking at that over here, you need to look at a couple of things. Okay, the first thing here is look at how much tech can move. Now, I am looking at something very specific here. I'm looking at the year-to-date performance. Look, you can use FinViz and then come to the maps. Okay, how do you do this? Go to FinViz. Okay, let me show you. Go to finviz.com. You'll be brought to this. Go to the map. Click on this. Right? Everything's green today. Okay, but look at the year-to-date performance, which means to say from last year to this year, same time period, what is performing and how are they performing? Okay, so look at these, Microsoft and all the tech, up between 20 to 40%. Consumer electronics, Apple up 50%. Software up an average of 20, 30, 40%, right? Information technology, some are up, some are down. Semiconductors, some are up, some are down. Intel with irrationality there, right? Communication services up big time. Amazon up 66%. Okay, home improvement, Netflix, right? And all these, look at that, right? All up big time, right? Now, would you put your money into these? You can. They're good companies, but will they give you superior returns? Probably not, right? Now, what are the ones that are the most red? Banks, right? And then banks regional. This is banks diversified, okay? And look at these two. They're down big time. Okay, now I'm not saying go and buy banks. There's a reason why my pick is not banks, but banks is a pretty good investment as well. But I'll tell you my first pick and then my second pick. My second pick is banks. My first pick is actually energy. And look at energy. Okay, and guess what belongs to energy? XOM, ExxonMobil. Okay, one of them is ExxonMobil, the other one's Chevron, right? And then you have a bunch of other ones as well. Look at some of these. They're beaten up, like really beaten up, okay? Now, I love things at a discount. I love, absolutely love, okay? And then you also have aerospace stocks, okay? Part of industrials. Look at Boeing, right? Look at all the ones that are like dead, okay? So these are the ones you should be concentrating and putting your money into because they will eventually rebound. Now, the reason why I'm calling this out now, oh, thank you very much for the $3.99 donation, Mario. I really appreciate you. Thank you. Okay. The reason why I'm calling this out right now is because the fact of the matter is that eventually what's going to happen is that there will be news, and you can see the market already releasing news about vaccines. There was news about Russia. There was news about, I don't know, Moderna. There was news about so many other companies making vaccines. And this is all not going to happen now, okay? It's not going to happen now. It's going to happen in 2021, okay? But what you should be doing now is positioning yourself to take advantage of when the vaccines get approved. If you wait for the vaccines to be approved and then you get into your trade, you're too late, okay? So what you can do is buy up these beaten stocks, okay, and take some leaps on them and benefit when the whole situation improves. Now, the first sector to improve when vaccine is going to be back online, or when coronavirus is going to be curbed or curtailed, is going to be the energy sector and the industrial sector, okay? And the travel sector. And I say the industrial sector means the travel sector is included, right? Airlines, your any industrials like Boeing, and also your defense companies, and energy. Why? Because the market will start pricing in people going out and people spending money outside of their homes. Okay, so what you really want to do here is to basically look ahead and say, I'm going to take a calculated risk to reward approach here to make an investment into the long-term sector. Okay, so the move is, after industrials, is to look at energy stocks. Now, it's so funny how we covered XOM this week, because XOM made a huge move. But I want to also bring your attention to this. Look at this, XLE, which is the ETF for the energy sector. And for people who don't know what an ETF is, this is basically like the S&P 500, but only for the energy sector. Okay, it's an index. It's an index. Okay, so a list of all the energy companies make up this one little thing. Okay, now look at this technical golden cross here to the upside on the 1 hour chart, right? And then we had a gap above, and now we're retracing and kind of sitting above this resistance. Now, all the resistance is now becoming new support. Now, we need obviously to wait for another confirmation to see a bounce and then an upward trend. So what we want is a bounce, make it high, make a high here, make a low here, make a higher low. Okay, make a higher low from here, make a higher low, and then we start to enter this trade long. Okay, so what we want here is something like this. We want it to go higher and then lower, and then make this new higher low. Then we can start to enter this trade into a long-term bullish position. Okay, this is the reason why I'm saying we haven't reached this opportunity yet, but we want that opportunity. So you have to start looking ahead, and you have to start with the fundamentals, build a case around it. If you realize, my approach is very case-driven, so I like to build a case around my investments. I don't like to just invest. Okay, so just. Can one of my mods please take care of these people who spam the chat? Thank you very much. I appreciate it. We would like to keep the chat as, as communicative as possible. We can just maybe ban this guy or mute him for a while for spamming. Thank you. I appreciate it. Also, so you want to get ahead of this little thing that happens. Okay, gap up, consolidating above the resistance. This is nice. Okay, and then look at the volume at the same time. Volume has been coming in, right? And it's heading higher, which is a good sign. Okay, so bullish on XLE, and now let's look at XOM here, which is ExxonMobil, belongs to XLE, right? So we want to definitely be following this one. Oh boy, what's going on in my chart? Come on, matey. Oh, it's spazzing out, guys. It's spazzing out. Oh boy. Let's see. Okay, XOM. Here we go. So now with XOM here, which is ExxonMobil, we're talking about this company. Now this is a company that's beaten down as well, right? Think about it. But then on Monday, if you attended Monday's live stream, you realize what I said. Oh, thank you so much for the $5 donation, Em. I appreciate you very much. Okay, so if you're looking at XOM here, what you would be thinking about here is, okay, so this is part of the energy sector, and it's been beaten down for a while, right? So it's been beaten down for a while, and you can see it kind of has been forming this little ascending triangle, right? And then it broke out of the triangle here, so it's looking bullish here, right? Now, playing this to the upside, is actually a pretty good move here. I actually like the prospects of taking $50 leaps for next year. Okay, playing this up to the 38.2 or the 50 retracement, 48 would be even better strike if you want to take a leap. Okay, but I do like playing this here. Okay, if you want to be cautious, buy it on the next dip. Okay, but I say good time to enter XOM here. It's funny how we covered this stock this week, and in the energy sector went up big time, right? So look at rotating into energy after industrials, but we're not done with industrials yet. Okay, industrials are barely getting started now. So we still have some room to go. But why not invest in both? That's my question. Okay, why not invest in both the beaten down sectors? Okay, now I know what you're going to be asking me. It's Tyron, why wouldn't you get into banks, right? Why won't you buy banks? Because banks are also beaten down, right? Well, the answer to that question is if you get us to 100 likes. No, I'm just kidding. But seriously though, guys, come on, let's get to 100 likes today. I really appreciate it if we can. They will actually share the stream with other people who want to, get access to the stream. So I really appreciate it if you do smash the like button. Okay, now the reason why you don't get into financials here is because interest rates are already artificially low. Okay, and when interest rates are artificially low, okay, we're talking about interest rates. I wish my pen would write faster. Okay, when interest rates are low, this squeezes banks' margins. Okay, why? How do banks make money? They make money by lending you money, right? Or they make money by offering money to businesses, right? Now, when interest rates go down, what happens to these margins? If interest rates are up and high, then the money that they make basically the banks put the interest rate to you, right? So if let's say the interest rate was 1%, I'm just going to give you an example here, arbitrary value, okay? If the interest rate was 1%, they would add their own maybe 0.5% or their own 1%, okay? And now the rate becomes 1.5 to 2% to you, the cost of borrowing, right? Now, if the interest rate lowers to 0.5, what happens? They can't possibly still charge you 1.5% to 2%. They can't do that because the public knows what the interest rate is, right? This is a decision made by the Fed, right? And they do that by controlling money supply, okay? So the Fed decides what the interest rate is, and if all of a sudden the Fed decides that the interest rate goes from 1% to 0.5%, and then the bank's still charging you 1.5 to 2%, are you still going to borrow from this bank? Absolutely not, right? So banks are forced to squeeze their margins, okay? And so banks can't make money in this environment, okay? Now, talking about investment banks is a completely different thing, and talking about commercial banks is a completely different thing, okay? When we talk about JP Morgan, Goldman Sachs, and all of that, those are investment banks, okay? And investment banks, they operate differently, okay? They are the only ones that make money in this market, okay? Why? Because they do smart investments, right? And they do IPOs, they do mergers and acquisitions, they do financial planning and management, okay? So I'm talking about commercial banks, Wells Fargo, Bank of America, right? Until interest rates improve, don't expect banks to recover. Hence, the reason why I'm not bullish on banks just of yet. Look, you have to build a case around your investment thesis. You can't just go blindly and say, oh, this is sold off too, so let's stop buying banks. Now, Funnily and Morgan is actually one of the banks that I would be comfortable buying at these levels, okay? But the problem is that JP Morgan is also looking slightly bought up here. And that's the reason why I'm not calling out a trade for JP Morgan here, because we've rallied up pretty strongly here, and I needed to come back down in order to enter this for another wave up, okay? So we want to see a wave up, a wave down, and then another wave up. Remember that, okay? That's the reason why I didn't buy or haven't been buying JP Morgan, okay? Cool. All right. Oh, thank you, Caleb. I appreciate that. UNP 195, call 918. Let's see. UNP. I'll just do this one really quickly. Since you donated, I don't want to make you feel like I didn't cover that one. Let's see. UNP 195, call 918. 195, call. Oof, man. Union Pacific Corp. What does this company even do? I mean, well, 918, okay. You have a lot of time on it. That's a good option to hold, but the problem with this is, how's long-term looking like? Oh, interesting. I see a corrective wave before it goes up there, though. That's the thing. I think that you should actually sell that option right now. Okay? Wait for the wave to come down, and then rebuy it somewhere around here. You should be looking to enter around 184 after selling this here. Take the loss, whatever you have right now, because look, we are about to make a wave down. This was overbought. This is the wave up. You need a wave down, and then entry right here, right, in this zone. And then a nice liquidity dip here to get you the next wave up. So that's what I recommend with that. Look at how overvalued it is right now, right? You can also see RSI starting to cool off here. So that's my take on that. Thank you for the $5 donation, though. I really appreciate it. Let's see here. Can we get to 100 likes here? I really appreciate it. Okay. Now, looking at XOM fundamentals, which is what you guys are here for, let's just go through this really quickly because I want to make sure that we cover it. I kind of droned on too much about my ideas, which I get excited about, so I'm sorry if I kind of rant here. But I just want to go through the Morningstar financials of XOM. I already went through a little bit of the 10Q with you guys on Monday, so we don't need to do that. We're going to use a cheat sheet here with Morningstar, and we're going to go through the financials here. I'll tell you what to look for and what is good or what is bad here. Looking at the financials, they do it nice and summarized here. And then I'm going to go through the valuation with you guys, which I have prepared for you to show you the upside on XOM. And the reason why I was coming up with that little price target on the top there. So let me just get through this with you guys really quickly. Also want to maybe get rid of this, get rid of the OBV real quick, and actually get rid of the moving averages as well so that we can get a nice clean looking chart here. There we go, perfect, much better actually. Okay, so let's have a look at this here. Look at Exxon Mobil, and by the way, I still maintain my bullish rating of this company. Okay, look at the revenues growing very nicely at 10% per year, annualized over 3 years. Now, obviously, this year is going to take a hit, but remember, this is a company that's seeing growing revenues. Okay, the 3 past years have been growing. Obviously, this year it's going to dip. All companies are going to have negative revenue growth this year, right? Operating income still at about 66%. That's wild, right? Net income at 22%. That is wild. And remember what we said, this company has a economic moat because it leads the market in chemical production. Okay, chemicals is what it has a leading on. So this company produces polyethylene and other polymers, and it does so as a market leader. Okay, so ExxonMobil has that added diversification to its portfolio. It doesn't just produce oil. Okay, it has a diversified model to its business, which is what we look for as an investor looking long term, especially if you're buying leaps. Diluted EPS at 21.36. Fun fact about this one also, they did not cut dividends, so dividends are still being held, which shows a good strength of the company trying to position themselves to retain shareholders. Okay, return on assets about 2%, not too bad. Return on equity about 4% here as of last year, which is still in the positive territory. And then the ROIC is about 3%, net margin about 3.3% here as well. Now, the quick ratio and the current ratio here, not extremely good, but it's okay because a company like this, it needs to take on leverage in order to do business, right? To build a oil rig or to build, things in the ocean and dig up oil and all that, takes a lot of capital. Okay, now is the lack of assets here a problem? Remember, when current ratios and quick ratios are less than 1, what does this actually mean? It means that they have lesser assets than liabilities, right? Because the current and quick ratios are assets versus liabilities. Okay, and since this company is a non-inventory based company, actually it is kind of, you can say it is an inventory based company, but I would still use the current ratio to value this company's metrics. It's about 0.93, so it's less than 1 here, which means it has less assets and more liabilities, right? That's why the numerator is less than the denominator, giving you a number that's less than 1. Okay, but is this a problem? The question is this a problem? And the answer to that is no, it is not a problem. Why? Because interest coverage is 10.25 times, which means to say that they can pay back 10 times of what they borrow per dollar. Okay, so interest coverage is 10.25. So this company can adequately pay back the money that it is borrowing in terms of interest expense. Now, the other thing to look at, is this a problem? Once again, no. Why? Look at debt to equity. The debt to equity represents the debt over the equity of the company, right? And so if there is less debt than equity, then shareholders are in a good place, right? And if this is less than 1, that's a good thing. So over here, the debt to equity is less than 1. In fact, it's 0.039, which is really good. So your shares are actually not too diluted. Now, the PE ratio of this company is also, by industry standard, slightly below the average, which means the company has been oversold here. Okay, so all of these things point to a very good fundamental for this business. Okay, very good fundamentals for this business, in my opinion. I like the business at this price. I would buy. I would be a long-term investor. Okay, in terms of cash flows, they're not the extreme best. They haven't been doing extremely well, but hey, it's COVID, and there's a lot of businesses that are suffering right now. So looking at the cash flows for the past 5 years, we're looking at cash flows that have been inconsistent, and partly it's because of the cash flows from investing and financing activities here, because they are a very erratically driven business, right? Seasonal and whatnot. So you have to take that into account. Operational cash flows is not a very good way to value this business, just as how, and so you cannot use cash flows to value a energy business because they are a seasonal business sometimes. So therefore, cash flow would not really dictate the success of this business. Okay, cool. Let's see here. Okay. Now, also remember, this company has got a great long-term prospect of dividends as well. So remember that. Okay, cool, man. There have been a lot of comments here, and I hope that I will be able to read some of these later. Thank you guys for attending, by the way. Appreciate you. Thank you for getting to 100 likes. Let's see if we can get to 120 likes. Maybe you can take a second here and just smash the like button once again. Maybe we can get to 100 likes, 120 likes here. I would appreciate that. Okay, so now moving into the valuation here. So for this particular company, as I just mentioned, okay, we don't want to use the normal approach to do a DCF here. Okay, what I want to do instead is do a revenue exit DCF, which is going to be slightly different from the usual route. Okay, and doing a revenue exit DCF gives you a better idea because you're going to track the company based on the revenues, the revenue growth, and give that a higher weightage. Okay, so over here we can see ExxonMobil with this year projecting, we're going to project about a 27% negative growth. And then next year, we'll project a 20% growth when the market rebounds. And then moving forward, we'll project about a 10% growth average, roughly, between the next 2 years, and then a steady 2 to 3% growth for the next 4 years. Okay, so that gives us a aggregate, okay, and gives us a better understanding of how this business will perform in the next 10 years. I always like to do a 10-year approach. Now, CapEx 5-year average is about 8.4%, but I have actually amended this to reflect a higher CapEx because chances are that this business is going to end up spending more money to make more revenues, and so the capital expenditures are going to increase over the next 5 to 10 years. Therefore, I have chosen to kind of start with the high and then kind of dwindle down here into a lower CapEx. Okay, working capital remains about the same, 1.6% average, which is the amount of money it needs to sustain its business. Depreciation amortization at about 7.6%, and I'm going to go with about 7.2% average here just to kind of improve the numbers here. The tax rate at 27, we're going to take a slightly higher tax rate at 27 here instead of taking, a slightly lower tax rate at 26 here instead of 27, just accurately making this 2 years as lower than what these 3 years were so that we can get a better average here. And then the discount rate, we're going to look at a slightly higher than usual discount rate because of the increased expenses during the COVID-19 crisis. Okay, and as I have mentioned, so we're going to take a 9.5, and a 10% discount rate here, and then a selected revenue multiple of between 1.7 and 0.7, which gives us the mid of 1.2 times revenue going forward. Okay, now all in all, this gives us a fair value estimate of about 61.13. This is the price target for ExxonMobil within the next 1 to 2 years, I would say. Okay, now obviously investors are going to view this differently, but if you're looking at a 61 price target, that's way up here. We're seeing a move that's going to go up to this level here, right? Somewhere up here. So us retracing back to 56 is definitely possible. So I say picking up some $50 leaps, okay, for next year, or picking up some $52 leaps, or if you really want to make some nice money, put some $48 leaps in for next year. Okay, and then you can take hedges on this as and when you need it by shorting XLE or something like that. Okay, so you can definitely play around with the idea a little bit. All right, guys. Well, finally I got through all of that. That was a lot of talking for me to do. I was trying to put everything out there so that you guys can get the maximum out of the stream. I'm going to read some of the comments here. I appreciate you guys being here. Thank you guys so much for the donations today. I really appreciate you. Let's see here. All right. Good morning. Good morning. Definitely read all of this over here. I'm going to try and answer a couple of these without going through the charts here. Try B 210 821. That one I can't do without reading the chart. But okay, funny thing that you guys don't know about Berkshire B here. You guys do know that Berkshire is just like the S&P 500, right? So if you want to track the Berkshire, it's all very similar to the S&P 500. So I recommend whenever you're looking at Berkshire, look at how S&P 500 will react. Its beta is very close to the market beta. Okay, so the riskiness of that portfolio is the same. Kodak here, definitely don't want to be buying puts anymore. I think that you should have sold puts when there was immense people selling puts there. So I'm not sure I quite agree with this trade over here. I think the time to buy puts are over. Tesla 160 call, both bought last week, 150 call. People who attend these times know I don't like to cover Tesla, but I'll say you could hold it if you want. Personally, I think that it will cause the stock price to rise with the split. That's all I'm going to say. Once again, Berkshire B here. Refer to the S&P 500 and my analysis on S&P 500 for Berkshire B. Okay. We're trying to be 2 steps ahead, not 1 step behind. Absolutely. Yes, absolutely. Never heard that before. I've been an idiot. Yep. I know that. Okay. Oh, yes. Good question here. Okay. Important announcement is, remember that for people who have been asking me, when is the next mentorship happening? It's happening this Saturday. Sign-ups are this Saturday. So remember, I put out this infographic on Instagram. Learn how to be a profitable trader in 5 days. If you want to learn my trading system, remember, I'm not teaching you a trading I'm not going to go through my indicators on the mentorship course and just leave you there. I'm going to teach you my trading system. Yes, I have a system. Okay, so if you want to be a part of the mentorship program, which starts on next Monday, okay, the mentorship program starts next Monday on the 17th, and it's going to be 2-hour classes or 2.5-hour classes every day from Monday to Friday at 9 p.m. Eastern time every single day. And if you can't attend it, there will be recordings sent to you. Okay, that enrollment's going to begin on the 15th of August, this coming weekend, on optionswing.com. Okay, if you go to optionswing.com, you'll see when you click on the sign up button here. Let me show you real quick so you know and you're not confused. You click join now, and you scroll down. You'll see Everyday Growth Advisors beginner course. It's currently sold out, but we're gonna this will be live at 12 p.m. on Saturday. Okay, so on the 15th of August, this will be live at 12 p.m. and you will be able to purchase the course. Now, some results from the previous alumni course, I'm not sure if they are in the live stream right now, but if they are, you can, tell people how this course has changed your life, to see your portfolio going from a down, and then boom, after the course you take it and you see this kinds of results where, before the course you've been going down and down and down, and then you see this kind of results. I think that is a very powerful testimony. It's effective. Okay. And the core values are to build a systematic trading system. So I will be teaching you that using probability and statistics, okay, math-driven approach, improving the odds of success through risk management, putting capital preservation at the forefront of your trading career, and fixing your trading psychology, which your brain is on auto mode right now. So this is what we're focusing on. The curriculum is going to be Monday, Tuesday, Wednesday, Thursday, Friday. We have a different things here for the curriculum. Make sure that you're following me on Instagram at Everyday Growth Advisor. I'm going to put it in the chat here so that you can follow me on Instagram. It's actually in the description as well. Everyday Growth Advisor with no S. That's my Instagram. You can give my page a follow. And this is going to be the curriculum. I have made a post about this, so you can go have a look at it on Instagram as well. Remember, we have live daily Q&A sessions with me for 2 weeks. You'll have access to me for 2 weeks. You'll have retention quizzes given to you each day, and all classes will be recorded and sent to you every day. Okay, so this course will be $330 for non-option swing members, and if you are a option swing member, you will use a promo code which we will post on the Discord channel to get you $80 off the course. Okay, so I just want to put that out there. This is starting on Saturday. The sign-ups start on Saturday. Classes will start on Monday. Okay, so keep that in mind. If you need a reminder, I will remind you on Friday again. Okay. Zoom, I like that one. You can hold that 235 put. I think it's a good one. You should hold that one. MGM. Unfortunately, I can't go through all of these right now, but I hope I can. What are good energy ETFs? I told you XLE. That's the one that I'm looking at. For real, you're getting popular in OS chat. Okay, let's go, gang. Oh, let's see here. Okay. December or January calls? I would say go for January. Don't go for December. That's what I would go for. Awesome info. Thank you, T, sir. Informative. You're welcome, man. Well, thank you for attending the stream. I really appreciate it. Awesome. Grabbed some 48 calls. ZOM yesterday. Great. I think you meant XOM. We'll roll up to the upside in later date. That's awesome, Sarah. Great choice there. Sounds like a decent gem for a long-term portfolio. Absolutely. Do you need to own XOM today or yesterday to get the dividend? Thanks for the in-depth analysis. No problem. When was the dividend posted? I think. Oh, the dividend hasn't. You should buy it as soon as possible because they haven't announced the dividend yet, from what I see. Or maybe they did. Look at what the ex-dividend date is. You gotta look for that. The ex-dividend date is what will determine it. Okay. What time are the classes? They're at 9 p.m. every single day. 9 p.m. Eastern time. Okay. Oh, there you go. Mecha 1045 is me, Mario. There we go. Take the course. It works. He's the guy who made this kind of a gain. Mario, thank you for coming into the stream. Thank you for your testimonial. I appreciate it, man. This is Mario's journey before and after taking the Everyday Growth Advisors mentorship course. So I highly recommend you guys to listen to his advice. Every day starts at 9 p.m. Eastern. Yes. What you can do, Leo, is attend the class at your own leisure time. Remember that the recordings will be sent to you daily. Okay. Ex-dividend is today. Then you have to own the stock today. You have to own the stock on or before the ex-dividend date. Okay. All right, guys. That was a smashing live stream. I appreciate you guys coming in. I'm sorry that I can't get to these tickers sometimes. There's a lot of content to go through, and I want to make sure that I get that out to you guys before covering the tickers. So I really appreciate you guys being here. Best course possible. Don't feel intimidated by the price. If you pay attention, you will make that back in one trading day. Appreciate that kind compliment, Stefano. Thank you very much. All right, guys. 2 minutes till market opens. You know where I'll be, option swing members. I'll be on the education chat if you need me. feel free to come through, keep me company there while I listen to my Econ Masters lecture as I answer your questions. So have a great remaining trading day, guys. Remember to smash the like button one last time if you're here. I really appreciate that, and have a good one. I'll see you tomorrow for another webinar. Remember, tomorrow we have a webinar on how to trade breakout patterns for the watch list. Okay, and I'm going to talk to Will. Maybe I'll get him to come back on to talk about this once again. So definitely attend tomorrow's webinar. We'll have another webinar series, 8:30, same time. Be here. I'll see you guys tomorrow for another educational series. Remember how we do it. Thank you guys for attending. Have a good one, guys. Peace.